Saying it sees a path to a soft landing, and staffers there do not have a recession in the forecast. But we may be in what's being dubbed a richcession. The term, originally coined by Wall Street Journal reporter, refers to wealthier members of society feeling the effects of an economic downturn, mainly driven by mass layoffs and white-collar work. Now, earlier this year, we saw the bulk of high-profile job losses across industries like finance and tech. It comes as UBS finds global wealth decline for the first time since 2008 last year. So did the number of millionaires. More than half of them were in the U.S. Joining us now to discuss this trend further is Mark Hamrick, a senior economic analyst at Bankrate. Mark, thanks so much for joining us. So when we think about this kind of concept of richcession, is this a thing? Is this like a real thing? Is there a richcession happening?
Well, I'm not sure I love the notion of having to weigh in with an analog yes or no to that, because I think it's a little bit more nuanced than that. First of all, the figures that you shared there, that's good data, that's good research. That's also for last year. What has happened this year? We've had a strong rally in equities. And so those who are most wealthy are most likely to benefit from that. And it's true. You're referencing the fact that we had a stiff number of layoffs at the beginning of the year, job cuts, job cut announcements, and that did tend to favor the technology sector, financial services, among others. But that is absolutely relented here now as we're sort of in the midpoint of the third quarter. And as we know, the other economic data, whether it's the unemployment report, whether it's jobless claims, that has remained remarkably resilient. And so one of the reasons why I resist the notion of sort of clapping in favor of this concept is it sort of takes a, oh, woe are the rich approach to this issue. And I think that's oversimplification. We still have a huge problem with wealth inequality in this country. And we still have a massive number of hugely wealthy people in this country. But it might be that upper middle class individuals have suffered some of the brunt of the weakness in the job market. But whether they would be considered as rich, I think that is a bit rich, to be honest.
Mark, when it comes to the job losses that we have seen from corporate America since the start of the year, yes, a lot of these names that we follow so closely, especially in the tech sector, have been responsible for the bulk of the job cuts. But when you have a Fed that has left the door open to more rate hikes, and you take a look at the data out today, it's getting a little bit more likely that maybe we could see another hike by the end of the year. What's that going to do to the job market? Are we still going to be able to see a tight labor market under those circumstances?
Well, so when you're saying it may be more likely, that might be talking about a probability of going from, let's say, 20 to 25% at this point. And I'm completely on board with the idea that the Fed is watching the data closely. The Fed doesn't want to limit its options. And that's why I don't necessarily expect this to be an earth-shattering Jackson Hole speech from Chairman Powell, given the fact that we've got to wait until September 20th for their announcement. But to your question, if we were to see rates increase, absolutely, it would be more restrictive. And let's think about the so-called real rate, where the federal funds rate at essentially the midpoint now of 5.375% increases on its own as inflation goes down. And so to some degree, along with the limited, or I should say falling lending, both demand for loans and the availability of loans, as that fourth line in the last FOMC statement said, the impacts of that on things like growth, unemployment, and inflation are uncertain, and it does present a downside risk. But if anything, I think people are getting on board that bandwagon that has to do with the notion of a soft landing. But we will have a recession at some point. We just don't know the timing of that, the depth, or the duration.
Okay, so you say we will have a recession. Obviously, we will have a recession at some point. Even the Fed has basically indicated that it looks like the path towards a soft landing is in sight. And to kind of move away, I guess, from the term richcession, one of the concerns is it could be more of an effect, a broader effect than just high-income earners. What is right? So, what is your expectation about like how much the job market could be hurt? Like, could this be we may not see unemployment rise too much, but what is your expectation as we head towards the end of the year?
Well, I like, first of all, that you did reference there what the Fed has talked about, and also referencing earlier that the Fed staff was suggesting that we would experience a recession this year, and Chairman Powell resisted that. And at the last news conference, he said actually the staff now has sort of taken that card off the table. But he has said many times, and anybody else in his comparable position would say the same, that predicting recessions along the lines of what we're talking about is very difficult stuff. And let's think about what caused the last two, which were doozies. We had the great financial crisis and a pandemic. Raise your hand if you predicted either of those two things happening and able to predict where that unemployment rate leveled out in the peak of 10% in the GFC and 14.7 in April of 2022. I think the likelihood is if we do have a recession, let's just say over the next 6 to 18 months, and essentially it's going to be caused by central bankers, barring an event the likes of which we can't predict right now, whether it's something geopolitical or something that's truly unpredictable. But if indeed it sort of emerges that the aggressive rate hikes that we've had going back to March of last year, and as you say, could continue here, well, that would likely be the cause. And so in as much as the Fed causes that, the Fed can back away. And I think that's the most important thing, is that central bankers do have an immense amount of power in the control that they wield over economies, as we've seen over the last 15 to 20 years.
Mark, what do you see as the timeline for the decline in inflation? I know that's a very, very tough timetable to put on something like this, but when it comes to the stickiness factor of it, obviously surpassing many forecasters' expectations up until this point, will we see that change at all, that trend at least pick up a little bit when we're talking about further deceleration?
I'm a bit skeptical about that, simply because, we have made, I think, some better than expected progress, for example, with that year-over-year change in the CPI. But I think we don't want to cheer for a recession in order to get lower interest rates, or let's say a mortgage rate average that's below 7% for a 30-year fixed. But I do think that, I think we'll see some solid progress based on what we can expect between now and the middle or end of next year. And where we see consumer confidence improving, that's a good thing. The fact that we have wage growth that's above the rate of inflation, that's a good thing. We are making progress, but it's going to take some more time. And I think it'll be a while before consumers really feel much better about all that, because I do think there does tend to be a bit of a lag. They're still feeling a bit bludgeoned by this most recent experience, for good reason. The worst inflation in 40 years does have an impact on people.
Yeah, and we certainly saw that play out in some of the retail numbers that we saw this week. Mark Hamrick of Bankrate, we appreciate your time. Have a great weekend.
You too. Thank you.
Thank you.